Hello everyone, welcome to chapter 2. This is going to be a really important chapter because I'm going to be diving deep into the concept of non-liquidity. In this chapter, I'm going to break down exactly what liquidity is, how it works, and most importantly, how you can exploit it by understanding the details and intricacies behind it. I'll also go through the types of liquidity, how it influences price action, and how you can use the concept of liquidity to your advantage and potentially exploit price movement and expansions in the markets and derive an edge from it in your trading. So let's jump into the chapter. Alright, first up, let's discuss what is liquidity and why is it important. Let's start with a basic idea. In my opinion, when it comes to ICT concept, the way liquidity can be defined is that liquidity is the fuel that drives price action. That's the simplest and most powerful way to understand liquidity. Basically, liquidity is what moves price, and then market makers, whether people or algorithms, are always targeting key levels in the market where institutional and retail orders are stacked in the form of liquidity. That's the definition. Another way to think of liquidity is that it represents the collection of all orders in the markets. And wherever there is a cluster of buy or sell orders, that's where liquidity lives. And price will naturally gravitate towards those areas because that's where the most volume can be filled. So the main takeaway here is this: liquidity is the driving force behind the market. It's a collection of all the market participants' orders. And the market maker's job is to take out that liquidity in the form of hunting stop losses, filling positions, and creating opportunities. Everything that price does, every expansion, every reversal, every manipulation, it's all driven by liquidity. So, now that we've talked about what liquidity is, let's move on to why it is important and why you really need to understand its importance and its significance in order to become profitable. First of all, understanding liquidity helps you avoid getting trapped by retail manipulation. Now, the way the market is designed is it is designed to set traps. It is designed to build up liquidity and to lure in retail traders. And once it does that, it then reverses on those positions and manipulates price action to clear those levels and to take out liquidity. And if you understand how liquidity works, you will be able to see those traps forming ahead of time and you will avoid getting caught on the wrong side of the market. Second, it allows you to anticipate and predict price movements more accurately. When you know where liquidity is, you know where price wants to go next, right? You're not just reacting, you're planning ahead of time because you know where liquidity is lying, right? Price always seek liquidity before it makes its real move. And if you understand where that liquidity lies, you can get it, right? You can get in before the expansion move begins and you can position yourself to capitalize on that. Third of all, liquidity gives you the closest insight into what the market makers are actually trying to do. Now, obviously, we can never know their intention with 100% certainty, but out of all the concepts out there, liquidity gets you the closest to understanding and aligning yourself with what they are likely aiming for. And lastly, liquidity is at the core of all high probability trade setups. The best setups, the cleanest reversals, the strongest continuations, they all revolve around the concept of liquidity and drawn liquidity. So, liquidity is not just important, it's essential if you want to become profitable. If you want to accurately anticipate and predict strong expansions or directional moves. Alright, now that we've understood what liquidity is and why it's so important, let's talk about how it actually works and how you can exploit it in your trading. Now, here's the deal: price only moves for three reasons. It moves either to generate liquidity, to purge liquidity, or to fill liquidity. That's it. Every single move you see on the charts fall under one of those three categories or those three objectives. Price is either creating liquidity in the form of forming equal highs, equal lows, or forming low resistant liquidity runs or failure swings, right? Price does all of those things to generate liquidity, or it moves to hunt that liquidity in the form of forming manipulation profiles above or below swing highs and swing lows, or equal highs and equal lows, or price is moving to fill liquidity in the form of rebalancing inefficiencies, or filling gaps in the form of filling order blocks, or filling fair value gaps and opening gaps, and so on, right? And apart from that, everything else that you see is just noise, right? But the thing is that every single move you see on the chart falls under one of these three categories, right? Now, understanding how price moves in relation to liquidity gives us an edge, right? And not just a small edge, a significant one. Because once you get that liquidity is what fuels price, right? And you believe that liquidity is the driving force behind the market, you can then begin to strategically position yourself ahead of time, right? Instead of reacting to price, you are anticipating where liquidity lies, and you're planning your trades based on where price is likely headed next. And this is where liquidity becomes super practical. It helps you clearly identify two things: reversal moves or continuation moves, right? You'll start to spot whether price is just purging liquidity for a reversal, or if it's building up liquidity for a strong continuation move. And by learning to differentiate between those two, by the understanding of liquidity, you'll be able to filter out bad trades and take high probability setups with more confidence. So, to sum this part up, by learning how liquidity works and seeing how price interacts with it, you put yourself in a much better position to read the market, avoid traps, and trade in sync with the bigger picture. Now, let me break down the concept of liquidity with this graphic right here. First of all, let's discuss this price action on the left. You can see with this price action, price formed these equal highs and formed these failure swings, right? Price wasn't able to take out this initial high and form this low resistant liquidity. And it did that for one purpose. It did that so that it could generate liquidity above these highs, right? It generated low resistant liquidity. Then in the second price action, you can see that after it generated liquidity, the only move that made sense was now to take out this low resistant liquidity and to have a low resistant liquidity run, right? And to purge this liquidity above these equal highs. And you can see price expanded above, had this manipulation profile, and with this particular move, it took out the liquidity, and from there, it reversed lower. And then in the third price action, you can see that after it had the reversal, it then found, maybe let's suppose we have a fair value gap here, or maybe we've got this breaker block as well. And from here, you can see price retraced back higher, filled the liquidity in the form of maybe testing the fair value gap, filling the fair value gap, testing this breaker block right here, and then expanded lower. Right? The reason it had this retracement move higher is to fill liquidity. So you can see that based on liquidity, you can basically categorize all of these moves into either one of those three categories, right? Price only moves to either fill liquidity, purge liquidity, or generate liquidity. Okay, so now in this slide, let's talk about the types of liquidity, what they are, how they work, and how understanding them can help us make better trading decisions, refine our analysis, and improve our ability to anticipate and predict price moves more accurately. So, at its core, liquidity can be broken down into two main types: external range liquidity or ERL and internal range liquidity or IRL. Now, each one of them has its own characteristics and price react to them differently. The first one being external range liquidity or ERL refers to the highs and lows or swing points on the charts. These are the obvious areas where stop losses from both retail and institutional participants tends to sit. So naturally, these areas become liquidity pools that price is drawn to. On the other hand, internal range liquidity or IRL refers to the gaps in blocks within a price range, right? These could be fair value gaps, opening gaps, or blocks such as order blocks, breaker blocks, rejection blocks, propulsion blocks, and so on, right? These areas, right, these internal range liquidity acts as internal inefficiencies or internal zones that price often comebacks price often comes back to test, fill, or mitigate before it starts moving toward external range liquidity or make its bigger directional move. Right now, in some unique cases, IRL or external range liquidity can represent highs or lows too. For example, let's say price is rejecting below a low and a bullish order flow, or price is rejecting above a high in case of a bearish order flow. In those sort of unique cases, internal range liquidity could be in the form of highs or lows too. But generally speaking, ERL or external range liquidity strictly refers to highs and lows, while IRL or internal range liquidity typically refers to blocks and gaps. I'll explain these visuals later when we go over the chart examples. Now, the real power comes in understanding how these two types of liquidity interact with each other, because that's where the market structure and flow really comes together, right? Here's how it works. Price doesn't just randomly move from one high to another or from one block to another, right? External range liquidity and internal range liquidity move in tandem. They follow a sequence, and if you understand this sequence, it gives you a real edge, right? So whenever price takes out in external range liquidity or ERL, let's say it could be in the form of a high or a low, the next thing that it usually does is it moves into an internal range liquidity or an internal inefficiency. That could mean it comes down to test a block, fill a gap, or react to some internal inefficiency, right? And once that range liquidity is filled, price then starts moving towards the next ERL or external range liquidity, either a new high or a new low, right? And it begins its directional move towards the next external target, right? So you can think of it like a rhythm or a cycle from ERL to IRL, then ERL to IRL again, right? Price flows from external to internal, back to external, and so on. And this relationship is super important because once you understand it, you'll know exactly what to expect when certain things happen. For example, if price just took out a high in the form of an external range liquidity, you don't assume it will immediately take out another one, right? Instead, you look for an internal range liquidity or IRL fill, maybe a fair value gap, maybe an order block test, and so on, right? And once that's done, then you can look for the next external range liquidity target, right? This gives you a much more accurate roadmap of how price is likely to move. It also keeps you from chasing trades or expecting immediate follow through when you know what price has to go through this rhythm, right? From external range liquidity to internal and back to external, right? So, in summary, understanding the interaction between external range liquidity and internal range liquidity, it allows you to, first of all, read the market flow more accurately. Second, it helps you anticipate the next likely move with better confidence. And third of all, it helps you avoid confusion when price doesn't instantly follow through after a liquidity sweep. This is one of those concepts that really ties everything together and gives you a much more refined understanding of liquidity and market movement. So now let me explain the relationship between ERL and IRL with this graphic right here. First of all, inside this graphic, you can see that we've got this level right here, and this level is the drawn liquidity, right? Which means that price will be inherently and naturally inclined to move towards this level. And in this case, our directional bias will be bullish because the drawn liquidity is higher, right? So let's say price reacted off of a discount key level right around here, and because of that reaction to that discount key level, it had this expansion move higher. And with this expansion move, you can see that price took out external range liquidity to the left. And we know that after price takes out an external range liquidity, the next thing that it almost always does or usually does is that it then fills internal range liquidity. And you can see after it took out the ERL, it then went down to complete the next step of its cycle, which is to fill IRL. And after IRL, price had then and another expansion higher, and with that expansion, it took out ERL or external range liquidity in the form of taking out this high. And after that, it kept moving in the same fashion and continued the cycle higher towards down liquidity. You can see after it took out ERL, it then came down lower again to fill IRL or internal range liquidity or internal range inefficiency. And after that, again, the next thing that you must expect price to do, or the next thing that price will be gravitating towards, or the next thing that price will be naturally inclined to move towards, is ERL or external range liquidity, right? So you can see from this graphic right here, obviously it's a cherry picked graphic, right? It's not going to be just as clear as this on the charts, but this gives you a clear idea of the relationship between ERL and IRL. You can see price move from ERL to IRL to ERL to IRL, and it continued it continued moving in this sort of fashion until it reached drawn liquidity. And once it reaches that drawn liquidity, then the dynamic changes. And I'm going to and and in the next slides, I'm going to explain what happens after a key level, a high time frame key level is reached, or the drawn liquidity is reached, and how does that dynamic changes, and how can you adjust to that dynamic change. Now let's dissect this price action based on internal range liquidity and external range liquidity. Okay, so first of all, we're going to assume that the drawn liquidity is lower, and right around here in the top, we reacted to a premium key level, right? These are the two things that we're going to assume are the prerequisites for this price action right here, right? So the drawn liquidity is lower, which means that the directional bias will be bearish and will be naturally inclined to have bearish price action. Now, first of all, you can see that after reacting to that premium key level, what happened is that price had this expansion lower, and with this expansion or with this move, what price did is it took out ERL, external range liquidity. And after ERL, you can see price retraced back higher towards this fair value gap, and it tested that, which meant that now price has filled internal range liquidity after taking out external range liquidity. And after it filled internal range liquidity or IRL, it then had another expansion lower or another move lower, and with that move, it took out ERL. And after ERL, price retraced back higher again and tested IRL in the form of this order block. And again, after IRL is filled or tested, the next thing that price almost always does is it has a move or an expansion move to take out ERL. And in this case, we had this ERL generated, and price then came down lower, took out this external range liquidity. And after external range liquidity, price then again came above higher to first of all fill this fair value gap and test this order block, which meant that price has now filled internal range liquidity. And after it filled internal range liquidity, price then moves lower again to take out external range liquidity, which in this case is this low right here. And you can see price continues keep moving in the same fashion of taking out external range liquidity, then filling internal range liquidity, and so on, right? This is exactly how price moves from ERL to IRL, then again to ERL, and back to IRL, and back to ERL, and so on, right? This is how price moves. Now, obviously, the main prerequisite for uh, making this idea tangible is first of all, you must know the drawn liquidity, otherwise, you won't be able to figure out the correct ERL and IRL. So, now that we've broken down the types of liquidity, let's talk about one of the most important concepts in this entire framework, that is drawn liquidity. Now, honestly, this is the core of your analysis and your trade ideas. Every single trade you take, every idea that you form should be rooted around the concept of drawn liquidity. If your trade idea or your analysis isn't aligned with the drawn liquidity, chances are that it's going to fail or be inconsistent at best. So, what exactly is a drawn liquidity and why is it so important? Basically, your drawn liquidity is the most probable key level that price is reaching for on whatever time frame you're analyzing. It's the most likely level that price is being drawn towards, and it's the level that will often act as the magnet for price action. And whatever direction price is moving towards that draw, that becomes your directional bias. Now, this drawn liquidity can take many forms. It could be a high or low, meaning external range liquidity, or it could be a fair value gap, an order block, or any other key level that fits within that internal range liquidity framework. Now, the reason why identifying your drawn liquidity is so crucial and important is because, first of all, it becomes one of your strongest filters. What I mean by that is that once you know where price is most likely headed to, you can automatically filter out half of the noise. Let's say your drawn liquidity is higher or it's to the upside. That instantly invalidates all the bearish trade ideas for you, right? And because of that, you are no longer looking to short. And because of that, you don't care about bearish signals or bearish setups because you know that price is most likely drawn towards to the upside, right? And you don't want that you wouldn't want to trade in the counter direction. And vice versa, if your drawn liquidity is lower, you immediately disregard all the bullish or long setups. So instead of trying to trade every pattern or every model in both directions, you develop a much more structured approach and you're no longer randomly chasing trades because you are focused on one clear objective, trading in the direction of the drawn liquidity. The second reason this concept is so powerful is because it helps you stay aligned with the market. When you know where price is most likely headed, you stop taking counter setups that go against the trend or that go against the order flow. You're no longer second guessing whether this pattern is valid or not because you already have a macro level direction in mind, right? You already have a macro level direction in place and you know that you are only going to be trading in that particular direction, and this helps you avoid ending up on the wrong side of the market trying to force trades in a wrong direction, right? You stop forcing trades in a direction that price isn't interested in moving towards, and that's a mistake that most traders make. They end up chasing trades in the opposite direction of where the market is actually trying to go, and because of it those traders almost always fail. And finally, drawn liquidity helps you understand what the market actually wants to do and not what you want it to do. And because of it, you stop forcing invalid setups, you stop holding on to biased ideas that no longer make sense, and you start adapting to what the market is actually showing you. And that shift in mindset is huge because now your job is not to be right, but it is to position yourself in the direction that the market is already planning to go. And that's why the concept of drawn liquidity is so important. It simplifies your entire process and it actually aligns you with the market, right? And keeps you out of bad trades and helps you focus on the most probable scenarios and not the most hopeful ones, right? This is a concept that you'll come back to over and over again because it's the foundation of a structured and a high probability approach and high probability trading. Now let's talk about the types of drawn liquidity and what each one of them represents. Now, just to clarify, this is different from the types of liquidity that we talked about earlier. That was about liquidity itself, ERL and IRL, but here we're specifically focusing on the concept of drawn liquidity, which is a related but a separate concept. Now, to properly understand the different types of drawn liquidity, you need to bring in the idea of time frame alignment. And this is super important because it helps you recognize how different drawn liquidity form across different time frames and how they relate to the underlying liquidity types like ERL and IRL. Now, there are two common ways to align your time frames. The first one is using consecutive time frames. For example, if you're using the weekly time frame, then your lower time frame would be the daily time frame, right? You would be using the next time frame after that. And if you're using the daily time frame, then you drop down to the 4 hour is your lower time frame and so on, right? This is what we call consecutive time frame alignment because we are using consecutive time frames. The second method is the classic ICT alignment, where if you are using daily as your higher time frame, then for that your lower time frame would be the 1 hour. This is what we call the ICT time frame alignment, right? For example, if your higher time frame is the 4 hour, then for lower time frame, your specific time frame would be the 15 minute, right? Now both approaches for time frame alignment are valid, and you can use either one depending upon the context that you're working with. Now, with that in mind, we can break down drawn liquidity into two types: long-term drawn liquidity and short-term drawn liquidity. Long-term draw refers to the high time frame ERL or IRL, whereas short-term draw refers to the lower time frame ERL and IRL. Now, long-term drawn liquidity is the macro target that price is reaching for or that price is working toward over time, right? Whereas short-term drawn liquidity is the lower time frame ERL or IRL, which price may seek to hit or which price may reach for before it starts continuing towards the higher time frame objective. Now, the key part here is that price doesn't usually go straight toward the long-term drawn liquidity when there is a short-term drawn liquidity already present. And there is both short-term drawn liquidity and long-term drawn liquidity on price for price, then what price usually does is that it often first gets pulled toward the short-term drawn liquidity, and once it clears that level and takes out the short-term drawn liquidity or fills it, only then it starts moving toward the long-term target, right? For example, you might have faced this scenario or this situation where you know that the drawn liquidity is in a certain direction, so you start forcing trades in that particular direction. But then the next thing that happens is that price pulls back on you, reverses, and takes you out before it starts moving toward the initial direction that you anticipated. And then you start wondering, is that why that happened, right? And you don't know, and that leads to losses, frustration, and second guessing, right? Even though your original bias wasn't wrong. And in order to cope with that problem or solve that problem, you need to be able to differentiate between the two types of drawn liquidity, and you need to understand that at the same time both short-term and long-term draws can exist, right? And your objective first of all should be to target the short-term drawn liquidity, because that's what price does. Price first of all targets the short-term drawn liquidity. It gets pulled toward the short-term drawn liquidity, and once it takes that out, only then it starts moving toward the long-term drawn liquidity, right? So even though your original bias might be correct, but it could be incomplete at the same time because you are ignoring or because you don't know that there is a short-term drawn liquidity there first. And that way you won't be second guessing yourself, or it won't lead to frustration because you would know exactly what's going on, right? And this is really important to understand because a lot of traders makes this mistake. It's basically like you are right about the destination, but not about the path that price would take to get to that destination, right? So not only you have to figure out the destination, but also the path towards that destination, which means that not only you have to figure out exactly where price would go, but also exactly in what sort of fashion and in what sort of rhythm it would go towards the long-term drawn liquidity, or it would reach that draw. So understanding this relationship between short-term and long-term drawn liquidity is extremely important, right? It's important so that you could have better decision making, cleaner entries, and more accurate expectations and anticipations for price. And this awareness will keep you from jumping in too early or forcing trades in the wrong sequence, right? Instead, you will wait for the short-term draw to be taken out first, and then you will align yourself with the high time frame direction, the high time frame drawn liquidity once price is ready. Okay, so now that we've gone over everything about liquidity, drawn liquidity, and their types, let's quickly go over one final but very important mini topic, that is dynamic changes. So the idea is that you need to be able to recognize when the liquidity cycle is flowing normally and when it shifts, because you know that the market doesn't always stay in one mode. It shifts from one mode to another every time, right? And the way how it works is that typically price moves first of all in a continuous cycle from ERL to IRL, then IRL to ERL in back and forth, right? That's the default rhythm, right? Price sweeps external liquidity and then it comes back to fill internal inefficiencies and so on. But this cycle only continues until price reaches a major high time frame drawn liquidity. And once that happens, we often get a shift in the delivery dynamic and price starts to move from ERL to ERL directly, right? And skipping, meaning it skips the IRL phase temporarily. This is known as a CSD or a change in the state of delivery. And what this means is that after price hits a significant long-term drawn liquidity, the internal liquidity cycle pauses and price enters a more aggressive phase where it might just run from one ERL to another ERL without coming back to fill internal imbalances in between, right? This is what we call CSD. And once the change in the state of delivery or the CSD plays out, price eventually settles back into its normal flow, right? And again starts the cycle between ERL and IRL again, right? And that continues until the next major drawn liquidity triggers another shift. And being aware of this change is super important, because if you're expecting price to come back and fill gaps or test blocks, but it's now in a post CSD phase, then you'll keep waiting for retracements that never come, and you'll end up confused thinking something's broken when in reality the market has just shifted delivery modes, right? But once you know this, everything clicks, right? Everything clicks, and you'll immediately recognize what phase the market is in, and you'll adjust your expectation and your anticipations accordingly to that, right? So understanding dynamic changes isn't just helpful, it's necessary if you want to stay in sync with the market at all times, right? Because the market doesn't stay in one mode all times. Now usually it would be in a ERL to IRL to ERL to IRL phase, right? It would continue that cycle until a liquidity target or a high time frame key level is reached. And once that happens, price then immediately goes from one ERL to another ERL, and that dynamic changes, right? So you need to be able to differentiate that, and you need to be able to recognize that when that happens. Now let's walk through this chart example right here. So first of all, you can see that once price took out this exact high, it kicked off this bearish order flow. The first thing to note here is that we had a CSD, we had a change in the state of delivery, and that CSD caused a shift in structure. And after that shift happened, we started moving in a classic cycle of ERL to IRL and then IRL to ERL, right? And here is exactly what happened. First of all, price took out this ERL, right? It took out this low, right? And after it took out this external range liquidity, it then retraced back and filled this IRL before it started moving lower, right? And then after it took out this ERL again, right? After it took out this external range liquidity, again we had a retracement and we had a pullback. And with this pullback, we filled this internal range inefficiency and this internal range liquidity before we moved lower again. And once we filled that, right, we filled and tested this FEG, this IRL. After taking out this ERL, only then we started moving lower and took out another ERL in the form of these lows. And then again, we retraced back and filled this IRL, and we kept continue moving lower in that sort of fashion of taking out ERL and then filling IRL and then again taking out ERL, right? And you can see that continued until price came down lower and hit this discount key level, right? That continued until price reached this discount key level. And after testing this discount key level, that's where the dynamic changed, right? We no longer saw price moving in the ERL IRL cycle. Instead, what you can see is that it jumped straight from one ERL to another ERL, right? It took out a low and then immediately it took out another high instead of actually filling IRL and then continuing moving lower, right? And the reason it didn't do that is because we tested this discount key level, right? And as I said earlier, once price reaches a higher time frame objective or a higher time frame drawn liquidity, then exactly this happens, right? The dynamic changes and then we go from one ERL to another ERL, right? And with this ERL, right, after we had this expansion, and with this expansion we took out this external range liquidity and we closed above this high, which confirmed a shift in structure, right? Meaning we had another CSD. So now because of it, we started another bullish order flow. So now again, price will start moving in a cycle of ERL to IRL and then IRL to ERL and so on until price reaches a higher time frame drawn liquidity. And you can see after we took out this ERL, price then came down lower, filled this inefficiency, filled internal range liquidity in the form of testing this order block right here, this block right here, and then again once it filled the internal range liquidity, it went higher, had another expansion higher, and took out external range liquidity in the form of this high and this high. Now right here you can see the price failed to take out this high, but on GU it had a SMT divergence here, right? Meaning GU took out this high, this ERL, but EU failed to do so, right? But you can see that after that divergence, price then came down lower, filled IRL again after taking out this ERL before it continued moving higher. And once we tested this order block and this order block right here and filled this IRL, this internal range equity, the next probable and the next likely move for us was to then have another ERL move or another expansion so that we could take out external range equity. And you can see that with this move higher, we've now taken out another external range liquidity. Now, the important thing to understand here is that once price takes out ERL, the next and the most probable move for price is not to immediately continue expanding higher. That's a common mistake. But instead, the most or the more likely scenario is that price will retrace back and look to fill in IRL or internal range liquidity before doing anything further, right? Now to figure out exactly which IRL price might come back to fill, you can use a combination of dealing ranges and open high low close levels, right? I'll cover that process in detail in a separate chapter, but just know that that's what you typically use to find that IRL target. So in this case, you can see that price has taken out ERL. So the next likely move for price is lower to fill this IRL right here, right? The next likely move is not to go higher immediately, right? Even though we are technically in a bullish structure, but instead it's to move lower. And this is where a lot of people go wrong, right? If you were too focused on your higher time frame bullish buys and you kept forcing bullish trade ideas to the upside immediately after this ERL was taken, then you would have likely been on the wrong side, right? Not because your bias was wrong, right? Because technically you were right, your bias was bullish, the order flow was bullish, right? But because you were ignoring the cycle of ERL to IRL, right? So even though in this case your bias technically is bullish, you still would be expecting price to retrace back and have bearish price action because first of all it has to fill this IRL, right? That's why understanding this cycle is so important, right? It helps you avoid jumping the gun and entering too early. Now, since we are on the daily time frame in this example, right? So this IRL that we are expecting for price to fill becomes our long-term drawn liquidity for the lower time frames, right? And that's the target that we'd expect price to go before it resumes or before it continues moving higher again. Now from here, using consecutive time frame alignment, I'll now drop down to the 4-hour time frame to identify the short-term drawn liquidity and the short-term ERL in IRL. Now you could use the ICT alignment too, like the 1 hour under the daily, right? And that would work as well. Now both approaches are valid, right? It just depends upon the context that you're working with. Now, in this particular case, the consecutive time frame element made more sense because I'm analyzing this price action to determine my drawn liquidity, right? I'm not uh, analyzing so that I could have actual execution, or I'm not doing this for entry purposes, right? If I were looking to take trades, then I'd probably use the ICT element instead, right? But since I'm just working to determine or to figure out exactly where the drawn liquidity is, I use the consecutive time frame element because that made the most sense. So now looking at the 4-hour time frame, what you can see is that our long-term drawn liquidity for this particular time frame is this daily IRL here. We took out this daily ERL, right, which was our initial long-term draw. And now the next likely thing that price is going to do is to retrace back lower or reverse on this particular time frame towards this daily IRL. So this is our long-term drawn liquidity. Now, if we zoom in, what you can see right here is that we had this SMT divergence with GU. EU took out this high and GU failed to do so, which means that we have non-symmetry in price, right? We had non-symmetry in price. And this exact SMT divergence confirmed our buys that now price is going to retrace back to fill this IRL first of all before it continues moving higher or before it does anything further. So now from here, our expectation would be to expect price to continue lower. Now let's see what price does. So what you can see right here is that price had this expansion lower, and with this particular expansion, what you can see is that we took out this external range liquidity, right? We took out this short-term external range liquidity. And now that we've taken out ERL, the next thing, or the next most likely and probable scenario, or the most probable move for price, is to now retrace back higher and fill this short-term IRL, right? This short-term internal range liquidity in the form of this FEG before it continues moving lower towards this long-term draw, right? So now here, our short-term draw is first of all this fair value gap, right? Right? So instead of forcing trades straight away, forcing bearish trades from here immediately, you would be expecting price to first of all fill this FVG before it continues lower, right? And what you can see right here is price had this SMT divergence with DXY. If I show you the DXY chart, then you would see that DXY filled this FVG and filled this IRL, meaning that after we took out this external range liquidity, DXY retraced back lower and filled this internal range liquidity just like we expected or just like I anticipated, right? Now on EU, it failed to fill this IRL or test this gap or this fair value gap, but it did that because of this SMT divergence. So technically our bias was right. Right now, EU might not have filled this FEG, but it only didn't do that because of this non-symmetry or because of this SMT divergence. So technically, you can say that our initial bias was right. EU retraced back higher to have this internal range divergence, right? Or to fill this internal range liquidity in the form of DXY filling this corresponding FEG. And then once it did that, and once it had this SMT divergence, only then it started moving lower and had this expansion lower. So let's continue this session. So now again, you can see that with this expansion leg lower, we took out another ERL, right? We took out another external range liquidity. So now from here, our expectation would now be to again expect price to fill this IRL or this IRL, right? Before it continues moving lower, right? Before it continues moving lower toward this long-term draw. And what you can see right here is that after we fill this fair value gap, right? After we fill this internal range liquidity and had this SMT divergence, this key level SMT divergence with DXY, we then continued moving lower again towards the long-term draw. What happened here is that instead of continuing moving lower immediately toward the long-term draw, it first of all filled this short-term draw, which is this internal range liquidity, and then it continued moving lower. And along with that, we also had this key level SMT divergence. EU failed to test this FEG, but on DXY, you can see that we tested this FEG, which means that we had non-symmetry and we had SMT divergence, and that confirmed that now price can continue being moving lower to take out another external range liquidity. And in this case, our next external range liquidity would be this low right here. Now, looking at this another example right here, you can see that on the weekly time frame, gold took out this ERL, this external range liquidity, and now the most likely scenario for price is to retrace back lower to fill IRL or to fill internal range liquidity before it starts moving higher or before it continues higher or does anything further. And what you can see right here is that we've got this FEG, this internal range liquidity in the form of this weekly fair value gap. And instead of price continuing higher immediately from here, it first of all retraced back lower to fill this internal range liquidity. This is what we call the cycle of ERL and IRL. And this is exactly how you can improve your decision making process by understanding and by keeping this in mind that price doesn't move in a straight line, right? It moves in a cycle of ERL and IRL, and then from IRL to ERL and so on.